think the market right now with the dislocated pricing has really kind of shown us who are the good managers from the bad managers. So it's actually a very good time to look at what really makes a difference between a good portfolio and a bad one. And I think we like to think of it as the 3 Ps, right? Pricing, patience and proprietary network. Now, if we just cover those briefly, on the pricing side, it's never a straight line in Africa. There's always things that go wrong. So if you look at the GP's base case, does it price in that uncertainty or the unknown unknown? And you'll be very interested to see, if you look at the analysis of deals that have difficulty, and that's 75% of them, did they price that in or did they forecast that in their base or downside case? And often or not, it was either ignored or it wasn't priced in correctly. So you need a margin of safety. And that kind of feeds in to the second point, which is patience, right? You know, if you can't get it at the right price, you need to wait. And you know, I always remember the sort of 101 of private equity. We don't sit on a pile of cash, we're selective, patient investors. And nowhere is that more true than Africa. Because if you look at Africa over the last 12 months, we've gone from Africa rising to current dislocations and massive depreciation across the board in terms of currencies. Very difficult to predict, but it's there and it does happen, okay? And those dislocations mean the guys that were very patient at the beginning are now sitting pretty. So if they raised a fund 2 years ago and they put the foot to the pedal and allocated too much capital, maybe weren't so price sensitive, they're in a difficult situation now. If we look at the South African managers in particular, where the rand suddenly fell 30%, the guys that raised in 14 and 15 and were very cautious about their allocation strategy and thought through the portfolio selection are now in a very good space. So I think they go hand in hand. And then the third P we talk about is proprietary network. And you know, this really matters, and people on the ground to source proprietary deal flow is important. But if we look at the type of deals in Africa, a lot of them are buying from founding families. They're significant minorities, but it's difficult in some circumstances to get control. So how do you align yourself with the founder? How do you understand what his view on life and what his view on the deal is to exit? You can tie them up with legals, but at the end of the day, you're going to be in courts for 5 years or more. So the only way you can do that is to build through that touch, that informal network. You need to spend time with the management groups you're looking to back, not for 3 months or 2 months, but more like 6 months or 12 months. And the good guys we see doing deals have spent time with the management team maybe for 12 months, the deal may go away, and then it comes back to them. And they say, we really get what you were saying, we believe in what you're saying, it's not just capital. So I think proprietary network is really important. And one of the things we look at when we look at GPs is we go, what's the reputation of the GP like in the local market? Speak to the stakeholders, speak to the banks, speak to the businessmen and say, what do you think of these guys? So I think that's important. What I'd love to say about Africa is a realised top quartile track record. The problem is, it's just not there. So us being a Pan-Africa fund, we've got to get around that, and we've got to back people who've maybe got a partially realised, or even in many cases an unrealised portfolio. Now, there you need to look at what's been the performance aggregation, disaggregation to date. Has it been pricing? Has it been foreign exchange? Has it been deleverage? Has it been organic or acquisitional growth? What's driven the value today? And you've got to get comfortable with that, and then you've got to compare that to what do they say on day one. Are they you know, what their value creation was it by luck, or was it forecasted, and does it link in with the strategy? So you know, track record unfortunately is something that we can't really look at, and if it's a first time team with no track record, it becomes even more difficult. And then you know, one of the tricks is really to sort of follow them in their shadow process on their due diligence on actual deals, and see how they think and how they actually think about structuring and due diligence and so forth. A few more just to add. You know, strategy is always important. You know, we always saw, you know, during the last 5 years where Africa was rising, everyone could sell the Africa story. But what differentiated a good GP from a bad one was, did they really think through how they were going to articulate the strategy, and how differentiated were they relative to their competition. So strategy is always important, and what we've seen certainly in Africa is many managers now trying to raise a bigger fund and moving outside of their comfort regional zone and maybe moving into larger deals, and that's something that we can understand why they're doing it, because they want to get a bigger fund, but one must tread with extreme caution to do that. And then just to wrap up, clearly it's all about the team. Ultimately you're backing the team, and so does the team have the requisite skill sets across sourcing, structuring, adding value, operational excellence, sometimes technical expertise, and has anyone exited deals? Because it's not easy to sell a company, even if it is a good company with all the good things. Well, for us as an LP, and I think it reflects the wider community, is exits, right? So whilst it's a very good time now, we think, in dislocated markets to be putting capital to work. So anyone sitting on dry powder is in a good position. It's difficult if you're trying to exit a fund. And I think the challenge there is for GPs to exit when they see an attractive bid being offered to them. We've seen, again, mistakes being made by GPs in good markets. They get a very attractive multiple and IRR, and they don't take it because they think there's another turn of return over the next 2 years. Okay, they have no crystal ball on the market. The market is volatile. It goes down and bang, the offer's not there. So that's annoying for us, because we're always pushing, saying we need liquidity, we need IRR. There's also a movement, if you look at the US markets now, with the pension funds saying we worry more about liquidity, we worry more about IRR than we did in the past. Okay, so I think that's the first thing, and following on from that is successor fundraising. If you've got a portfolio that's fully invested and you can't exit, and you've got no dry powder, you've fully invested the fund, where does that GP go? It needs to raise another fund, but it can't raise another fund unless it shows some realised track record. So those two are in combination. I think, again, it's a big challenge, especially in the international markets now, where it's a kind of risk-off environment, where Africa is a particularly difficult sell. And you asked for one more. I think the last one's probably country risk. Nigeria at the moment isn't attractive for local Naira prices. If you look at asset prices across the board, they've come off significantly. But as a dollar investor, how do I access that? Because I've got currency risk, and I know for sure, or we think for sure, the Naira is going to go down over the next 12 months, maybe 18 months, maybe 6 months. So innovative ways of accessing that market, but not taking the full currency risk, is something that GPs also need to consider, rather than saying, okay, Nigeria is off limits for now.